If you don't know what a mutual fund is, or you're investing in them but you're quite unclear on how they work, this video is for you. This is episode 20 of 30 of our 2021 Money School, where we take you back to the basics of investing and personal finance. Hey, my name's Hervin, Pesa, I'm a financial planner, and I want to share money lessons that you never learned in school. So if you're ready to take control of your assets, consider subscribing and be sure to hit the bell so you never miss any of our lessons. What is a mutual fund? A mutual fund is a financial instrument that holds a collection of other investments. This is a basket that holds a variety of different investments and different asset classes. We know from our lesson on asset classes and asset allocation that how these investments are blended can have a massive impact on the overall portfolio returns. So what assets the fund holds inside it is extremely important for you to understand. A mutual fund is a pooled financial asset. It allows you to invest alongside thousands of other investors that gives you access to investment options that would have not otherwise been available to you or these other investors. Let's talk about pooled investing for a second. Let's meet Hugo. He's a new grad and he knows that he should really start saving and investing long term, but for now, all he can set aside is $200 a month. He's not sure what to invest in, but he's an Amazon Prime member. And looking at his recycling bin, he sees a pile of boxes from Amazon, so he thinks Amazon is probably a decent investment. Besides, he pays them so much, he might as well get some of it back. So he looks up Amazon stock online and finds that it's trading for $3,400. Well, it'll take him 17 months just to get to the $3,400. So he calls 20 of his friends, 16 of them happen to be Prime members also, and agrees with Hugo's idea. So they pull up all their cash together and buy a single share of Amazon, which they now mutually own together. This is where the name mutual fund comes from. All the investors mutually own it. Now, in the real world, Hugo simply needs to look up an existing mutual fund that agrees with his investing philosophy. It's the same idea, but one fund will have millions of investors investing and pooling money inside it. Instead of buying Amazon stocks directly, he would purchase funds that already holds Amazon stock. This makes him, along with millions of other investors, indirect owners of Amazon stock. What are the main benefits of using mutual funds to invest? Let's talk about 4. Access, diversification, reinvestment, and professional management. Let's talk about access first. See, access is about the low investment minimums. The first benefit that I highlighted is that even though there are now options to buy fractional shares, for most investors, purchasing stocks and odd lots is still not practical or feasible. So without pooling cash together, investors would have to park their cash for a really long time before they have enough to participate in assets. This means they're not taking advantage of compounding. This also holds true for fixed income and debt instruments. Keeping it simple, most of these debts are sold to institutional investors like funds and insurers. Think about wholesalers versus retailers when it comes to goods. Some products are not sold directly to consumers. There are lots of financial instruments that still operate the same way. Most mutual funds have low investment minimums. Some start at $1,000, but there are now that would start at $100. Some with 0, as long as you set a monthly pack or pre-authorized debit contributions. What likely happens is you start this pack and the cash gets pooled up until you meet the minimum investment size. The next advantage is dividend reinvestments. There are funds available that allows investors to reinvest any cash flow from the fund. You would automatically buy more of the fund as income is generated from it. The next benefit is diversification. See, even if Hugo was able to purchase the Amazon stock for $3,400, he would still have a highly concentrated position and his returns will hinge solely on Amazon's performance. If they do well, then that's awesome, but if they don't, then that's unfortunate for him. Most mutual funds will have at least a few dozen investment positions, some with hundreds and others have thousands. See, regardless of how little cash Hugo had started as his investing capital, it's going to be broken up to however many assets the fund holds. This makes him less reliant on one specific company doing well, and even if one of the holdings do poorly, he would be not as impacted as if he was just holding a single share. However, when you're looking at your mutual funds, you must still be aware of sector-specific risk, geographic risk, and systematic risk. A fund that's heavily invested in oil and gas and energy sectors factor means that they have different holdings, but the holdings are susceptible to similar risks. The next benefit is professional management. When you invest through a mutual fund, you're ultimately hiring a team of professionals to look after your cash and manage your investments and investment selection for you. If you don't have the skills, the time, the inclination, or any desire to analyze different investment positions, then having a team of professionals look after this for your investment benefit is a real plus. This team would include a group of analysts looking at economic environments, sector-specific research. See, essentially their full-time job is to look at what to buy and what to sell through the information that they have that we may not necessarily have easy access to. So how do mutual funds operate and how do they choose different investments? See, different funds and different fund managers will have different investment strategies and styles. Think of fund managers as a chef in a restaurant. If you want Italian food, there better be a trained Italian chef in the kitchen. After all, you're not going to see Jamie Oliver for egg fried rice, right, Uncle Roger?
What he say? What he say?
So how the funds invest and operates will be described by the prospectus and the fund facts. Oftentimes, the name alone will give you clues on how they operate. I'll give you a few examples. The name can tell you a lot about the asset allocation of the fund. A fund with the word balance probably means that it's a 60-40 asset allocation. If it's balance growth or balance aggressive, then it means that it tilts a 70-30 or higher. If it says equities, then it means that this fund is going to be tilted to equities. You may come across Canadian dividend funds. That tells you that it's a fund holding equities that are geared towards Canadian companies that have a track record of paying dividends. While international or global tells you that this will have exposure outside of Canada. Now, the word value will tell you that this fund implements value investing. This means it's looking at great companies that you can buy at a good price. They'd be looking at how much a company is selling for, its price, versus what they believe its true value to be. This is like you looking at good deals on Facebook Marketplace. You're not interested if it costs the same as where you would buy it from the store. While growth could then mean buying companies projected to grow their revenues, thereby their stock price. Growth investors don't necessarily look for discounted price, they look to buy now since they believe the stock will keep going up in price through increased revenue. What are the disadvantages of investing in a mutual fund? Honestly, I think the biggest drawback for mutual funds is most people still don't really understand what's inside them. Two, there could be a lot of tax complications if they're not held in a registered account. With directly owned equities, you can decide when to sell the asset based on your personal income. With a fund, it's not really up to you. Even if you don't need the income, if the fund needs to rotate assets, you'll add some capital gains on your taxable income that year. Third, this can only be bought and sold once a day. That goes on a cons list, but for long-term investors like you and I, we're not really looking to trade, so that's not going to impact us. Lastly, there's cost. So we have to look at cost and fees of owning a fund is a major factor. What does it cost to invest through a mutual fund? Most people are already aware of the management expense ratio, but there's a few other things to consider. There's also the trading expense ratio and sales charges. Let's talk about the MER first, or the management expense ratio. When you invest in a mutual fund, you're paying a fee as a percentage. This pays for the manager, research, filings and transactions, internal taxes. Really, this is for the operation and administrative costs of the fund. This is deducted from the gross returns which the fund earns. In other words, you don't typically see this as a line item when you see your statements because that's already net of the MER. If a fund has an MER of 2.5%, that would be taken off whatever the gross return actually was. So if your statement says 6.5% in returns, the gross return, what the fund actually made, is 9%. This fee will be taken off whether the fund has done well or it hasn't. If the gross return for the fund is a loss of 10%, your statement is going to show a negative 12.5%. Let's talk about the advisory fees, embedded commissions, or trailer commissions. The management expense ratio already includes trailer commission inside it. It's usually around 1%. In this example then, 1.5% of the MER is retained by the fund and the 1% is paid to the distribution channel. If you bought it from a bank branch, this is paid to the bank. If you got the funds through an advisor, they're usually a part of a brokerage network or a dealer network. The fund would pay the 1% trailer to the dealership and they would take their cut. Your advisor will likely get a 0.65% to a 0.85% trailer fee. This would be your investment advisors or your financial advisor's compensation. The 1% to the 1.5% is actually industry standard for advisory fees. The only issue is you're already paying this if you're investing in a mutual fund. What kind of advice have you received for this? Are you actually getting any personalized financial advice? The next cost is the trading expense ratio. This is a fund level fee that is separate from the MER. This is a separate trading cost. It's often infuriating for investors when I show this to them because they think the MER is all they pay. But this has to be a separate line so that when you open your fund facts, you can see it. And when you look at it, the reason that this is separate is it shows the pure trading costs. Funds that you invest in that has insane turnover is gonna have a higher TER because they're constantly buying and selling. The next costs are sales charges. These are the commissions to the distribution channel. It's a marketing charge. This is for selling you the fund, and there's really three kinds to know. One is the front end load. You'll be charged anywhere from 1 to 5% upfront. That's why it's called a front end load. Let's use a 5% number. If you invested $10,000 in a fund, you'll pay 5% or $500. So you'll be left with $9,500 actually hitting the investments. To recoup this, your investment has to earn 5.3% just for you to break even. There's also the back end load or deferred sale charges or DSC. This works like a redemption charge or a surrender penalty. Instead of paying a commission up front, you will get to invest the full amount that you want to be depositing. However, you'll be slapped with a hefty fee if you leave the fund too early. The fees would be anywhere from 5, 6, 7% to start. Then it phases out every year until it hits 0. Usually it removes 1% every year. But I've seen this lockup. This is particularly nasty for clients that don't know that they've bought a DSC fund. I have an example that I can recall. One of my clients was sold a DSC fund before she started working with us, and the way that she wants to invest and move forward no longer matched this mutual fund's performance and their strategy. So she wanted to switch to one of our wealth management solutions, but we couldn't accept it. See, I looked at the redemption schedule and I had a fairly good idea of the cost, but the number was large. I shared it with her and she still wanted to clarify, and I wanted her to hear it directly from the fund provider. So she called them and the penalty was about $6,800. So this can easily add up depending on how large your investment pool is. In that case, I had to be the one to say no. So I ended up referring her to another advisor who has access to the specific fund provider that she already has, but she was understandably upset. By the way, back-end loads are now illegal in all provinces except Ontario. However, that's already changing. The OSC has announced that DSCs will be banned starting June of 2022. However, I still had to put this information here because you may already be invested in a fund that was sold under a DSC, or you may be outside of Canada in a place where DSCs are still legal. When you review your statements, after the fund name, there could be acronyms like DSC or FE after that'll tell you how the sales charges were tacked onto your fund. Last, there are also no-load funds available to some advisors, so inquire about that. That means that you're not paying any commission up front. There's also no DSC charges when you pull out. I just want to share my final thoughts on fees. Well, maybe this is not really final. I'll do a separate video on this in a few days. The average MER in Canada is still at 2.3 to 2.5%. I've seen higher, and equities would inherently have higher fees than fixed income funds would, but that's fairly common as an average. So Google it and check what you're paying. I agree that fees are not everything. If I paid 2.5% and still got a net return of 7% compared to an alternative situation where I paid 2% but I got a net of 6%, I'd still be better off with the 2.5% fund, right? But see, returns are variable, but fees are forever. The fund strategies with higher fees must consistently outperform those with a lower fee, and Historically speaking, that's unlikely. But I do want to say this, right? Like, fees do matter. However, I'm not opposed to paying for services rendered to me. I expect that when I go to a restaurant, there's going to be added costs compared to eating at home because I'm being served. The problem is when we're served Happy Meals, but we're charged the price of steak and lobster. I'm not opposed to active management, but paying active management fees for closet indexing is a big problem to me. Closet indexing is when funds almost replicate the benchmark, but they still charge active management fees for it. With our clients who decide to retain us for wealth management beyond their initial plans, they typically save thousands every year because through our partnerships, they'll pay about 0.6% in investments and fund fees. So even with our 1% advisory fee, they still save money for our all-in and ongoing investment support. In most cases, the total fee, the total expense ratio is at 1.5%. And these clients have access to us, a portfolio manager, and they get a comprehensive financial plan and ongoing coaching. So imagine a young couple that has $100,000 in their RSPs or TFSAs would save about $1,000 every year coming from these funds. Granted that that's not always the case. We've worked with couples who were a little bit younger and they're with popular robo-advisor platforms, yet they went to us. The returns and fees were okay with wherever they were, but their life was far too complex for the level of service and advice that they were getting from the robo platform. So there's different ways, all right? That's what I want you to understand. If you want to consult for a simple portfolio and fee audit, you can sign up in our website. There's a link below in the description. Mutual funds can be a useful instrument. It all depends on how you're deploying them, which ones you're buying, what you're using them for. Understand that what's inside them is more important than owning a fund. You need to really understand what you're investing in and what constituents are inside the funds that you're buying. Make sure that the fees you pay is worthwhile. And you have to understand the difference between active management and passive investing. So in tomorrow's video, we'll have that discussion between passive versus active investing. Until then, stay aware, take control. I love y'all. Bye. Check out the full playlist here and be sure to subscribe.